My greetings to everyone. In the ongoing series of Finance for Everyone, today we will be discussing on trading of securities, in which we will cover these topics: the meaning and importance, the rules for trading, the process of trading, the types of securities in India and their features, the useful terminology which is used, the block and bulk deal, the bull and the bear market, the risk and return. So starting with this, first let us know about the meaning of trading of securities. The trading of securities refers to the buying and the selling of financial instruments like stocks, bonds, currencies, options and the futures in the financial market. The trading can take place on the various platforms, including the stock exchanges, over-the-counter market and the electronic trading platforms. Now coming on to the importance of trading of securities. The trading of securities is an important activity in the financial markets because it helps the investors and the traders to buy and sell the securities based on their expectations of the future price movements. The trading of security is facilitated by the brokers who act as intermediaries between the buyers and the sellers. The brokers receive the orders from the investors and execute them on the exchange or the over-the-counter exchange market, charging a commission or a fees for their particular services. The trading of securities provide the liquidity to the market by enabling the investors to buy and sell the securities easily and quickly. It also helps to determine the prices of the securities based on the supply and the demand of the market. The trading can be done for the short-term gains or the long-term investment purposes, depending on an individual investment objective and the risk tolerance. The trading of securities is regulated by the various regulatory bodies such as Security Exchange Board of India, we call it as SEBI, the Security Exchange Commission, we call it as SEC, and in the United States and the Financial Conduct Authority is there in UK and US. So these regulatory bodies, they aim to ensure the fairness, the transparency and the investor protection in the financial market. Now let us do some rules for trading in India. The trading of securities in India is regulated by the Security Exchange Board of India, that is SEBI, which is the primary regulatory body for the security market in India. The SEBI has put in place several rules and the regulations to ensure the transparency, the investor protection and the fairness in the trading of securities. Some of the key rules governing the trading of securities in India are: the first is a demat account. The trading of securities in India requires a demat account which is used to hold and trading securities in the electronic form. The second is a KYC rule. Investors are required to complete Know Your Customer procedure, we call it as KYC, to open a demat account and trade in securities. So this involves providing a personal information, identity proof and the address proof. Next we have is the trading hours. The trading of securities in India take place on all weekdays except for holidays declared by the stock exchanges. The trading hours are from 9:15 a.m. to 3:30 p.m. with a pre-opening session from 9 a.m. to 9:15 a.m. Next is your margin trading. The margin trading, which involves buying securities with the borrowed funds. It is allowed in India subject to certain conditions and regulations. Next we have is a insider trading. The trading on the basis of inside information is illegal in India and is subject to strict penalties. Then we have a settlement. All trades in the Indian security market are subject on a T+2 basis, which means that the settlement takes place 2 working days after the trade day. Then we have the price bands. The Security Exchange Board of India has imposed the price bands on the individual stocks to prevent excessive volatility in their prices. So these price bands are revised periodically based on the price movement of the stock. Then we have a circuit filters. The circuit filters are used to limit the price movement of a stock during the trading hours. So if the price of a stock breaches the circuit limit, the trading in the stock is halted for a certain period. So let us see the process of trading in India. In India, the trading of securities primarily takes place on 2 major stock exchanges. The Bombay Stock Exchange, we call it as BSE, and the National Stock Exchange, we call it as NSE. So the trading of security happens electronically through the computer networks. So here are the steps involved in the trading of securities in India. Opening of a demat account. The first step of trading on securities is to open a demat account with a depository participant. We call it as DP. This account acts as a digital account to hold the securities in the electronic form. Next we have is a placing an order. Once the demat account is opened, the investor can place an order to buy or sell the securities through a broker. The order can be placed either online or through a phone call. Then we have the third is your order matching. After the order is placed, the stock market matches the buy and sell orders based on the price and the quantity. In case the order matches, a trade is executed. Next we have is a trade confirmation. Once the trade is executed, the broker sends a trade confirmation note to the investor which contains the details such as the price, the quantity and the transaction cost of the trade. Next we have is the settlement. The final step in the trading process is the settlement of the trade. In India, the settlement for the equity trades is done on a T+2 basis, which means the settlement of the trade happens 2 working days after the trade date. It is worth noting that the trade in securities in India is regulated by the Security Exchange Board of India, and there are rules and the regulations that the investors and the brokers must comply with. Next we talk about is the types of securities in India. In India, there are several types of securities available for investments. Here are some of the common types. The first is your equity shares. These represent the ownership in a company and provide shares in its profit and losses. The equity shares are listed on the stock exchanges and can be bought and sold by the investors. Next we have is a debenture. So these are the debt instruments issued by the companies and provide a fixed rate of interest. Debentures can be secured or unsecured and can be listed on the stock exchanges. Next we have is a bond. So there are also called as the debt instruments that provide a fixed rate of interest. The bonds can be issued by the companies or the government can be listed on the stock exchanges. Next we have is a mutual funds. So these are investment vehicles that pool the money from the investors and invest in a diversified portfolio of securities. The mutual funds can invest in equity shares, the debt securities, or a combination of the two. Next we have is an exchange traded funds, we call it as ETFs. These are similar to mutual funds but trade like stocks on the stock exchanges. The ETFs can invest in a diversified portfolio of securities or track a particular index. Next we have is an option. These are the contracts that give a holder the right but not the obligation to buy or sell a security at a predetermined price on or before a specified date. Next is your futures. These are the contracts that obligate the buyer or a seller to buy or sell a security at a predetermined price on a future date. Next is your government securities. These are the debt instruments issued by the Government of India and provide a fixed rate of interest. The government securities can be bought and sold on the stock exchanges. Next we have is the commercial papers. So these are the short-term debt instruments issued by the companies to raise the funds. The commercial papers are typically issued for a duration of less than 1 year and are unsecured. Next we have the rights issue. Rights issues are the offerings made by the companies to the existing shareholders to buy additional equity shares at a discounted price. The next is your ownership securities. The ownership securities are the financial instruments that represent the ownership in the company, and when the individual or the organization invest in a company by purchasing the ownership securities, they become shareholders and are entitled to a portion of the company's profits and assets. So these are two main types of ownership securities, the common stock and the preferred stock. So let us now talk about the equity shares. What are the features of equity shares? Equity shares are also known as the common shares or the ordinary shares, which represents the ownership in a company and entitle the shareholder to a portion of the company's profits and assets. So here are some of the key features of the equity shares, out of which the first is the ownership. Equity shares represent the ownership in a company, giving the shareholder a right to participate in the management and the decision-making process of the company. Let us talk about the next feature of equity shares, that is the voting rights. Equity shares have the right to vote on an important matter related to the company, such as electing the board of directors or approving the major decisions. The next is your dividends. Equity shareholders are entitled to receive a portion of the company's profits in the form of dividends. The amount of the dividend is determined by the company's board of directors. Next is your capital appreciation. Equity shares can increase in the value over time, providing an opportunity for the capital appreciation. Next we have is a transferability. Equity shares are freely transferable, meaning that they can be bought and sold on a stock exchange or a private transaction. Next is your limited liability. The shareholders have a limited liability, meaning that their personal assets are not at risk if the company runs into financial trouble. Next is your risk. Equity shares are generally considered more risky than any other type of investments, as the value of the share can fluctuate based on the market conditions and the performance of the company. Let us now move on to the features of the preference shares. The preference shares, also known as the preferred stock, are a type of the stock that provides certain preferences or advantages to the shareholders. The preference shares are often used by the companies that want to raise the capital without giving up the voting control to the investors. They may also be used when the investors who want a more stable source of income than the common stock dividends. Next we have is a dividend priority. The preference shares provide their holder with a fixed dividend payment which takes priority over any dividend paid to holders of the common shares. Next we have is a non-voting right. Many preference shares do not come with the voting rights, which means that their holders cannot participate in the decision-making process of the company. Next we have is a fixed income. The preference shares offer a fixed rate of return which provides the investors with a stable source of income. Next is a redemption. Some preference shares are redeemable, which means that issuing company has a right to buy them back from the investors at a predetermined price after a certain period of time. Next we have is a convertibility. Some preference shares are convertible, which means that the holder have the option to convert them into the common shares of the company at a predetermined ratio. Next is your cumulative or non-cumulative. The preference shares may be cumulative or non-cumulative. The cumulative preference shares guarantee that if the company is unable to pay the dividend in 1 year, it will be carried forward to the next year and paid before any common dividends are paid. Whereas, if you talk about the non-cumulative preference shares, they do not provide this kind of a guarantee. Let us now talk about a debt. The debt securities are the financial instruments that represents the borrowed funds. They typically have a fixed interest rates, a specific maturity date, and a principal amount that is repaid at maturity. So here are the key features of a debt security, out of which the first is the interest rate. The debt securities pay interest at a fixed or a variable rate, which is typically determined by the credit worthiness of the borrower and prevailing market conditions. Next is your maturity date. The debt securities have a specified maturity date, which is the date when the principal amount of the security is due to be repaid. So the maturity can range from a few days to several decades. Next we have is a credit rating. The debt securities are usually rated by the credit rating agencies such as the Moody's or the Standard & Poor to assess their credit worthiness of the issuer. Higher rated securities typically have a lower default risk and thus the lower interest rates. Next we have is a collateral. Some debt securities may be secured by collateral, which can include the assets such as a real estate or equipment. The secured debt securities generally have a lower default risk than unsecured debt securities. Let us now talk about the liquidity part. The debt securities can be bought and sold on the open market, providing the investors with the liquidity. However, some of the debt securities may be less liquid than the others, depending on the factors such as the size of the issue and the credit rating of the issuer. Then we have a callability. Some debt securities may be callable, meaning that issuer has the right to redeem the security before its maturity date. So this feature can be advantageous for the issuer but can also pose a risk for the investor. Next is we talk about the convertibility. Some debt securities may be convertible, meaning that the holder has the option to convert the security into the shares of the issuer's common stock. So this feature can provide the investor with a greater flexibility and potentially the higher interest. Now, useful terms to know before investing in the securities. To start with the investment journey, one must know these terms. What are business days? These typically refer to the weekdays, which are the days of the week from Monday to Friday, excluding the weekends, that is the Saturday, Sunday, and a public holiday. In most of the countries, the business days are the days when most businesses and the government offices are open and operational. What is a pre-opening session? It starts at 9 a.m. and goes till 9:15 a.m. The orders for the transactions are placed. Then we have a trading session. It occurs between 9:30 a.m. to 3:30 p.m. Investors can buy and sell securities without any limitations. Next we have a post-closing session. It runs from 3:30 p.m. to 4 p.m. No transactions take place, but the closing price is determined during the period. What are blue chip stocks? We talk much about these are the blue chip stocks. So let us have a dive on this, on the meaning of what the blue chip stocks are about. These are the stocks of the large, well-established companies with a long history of steady earnings growth and, of course, the stable dividends. These companies are often the leaders in their industries and are known for their strong financial performance, quality management teams, and a strong brand recognitions. The investors often view the blue chip stocks as the safe investments because they have a track record of the consistent performance and are often less volatile than other types of stock. The blue chip stocks can provide the steady income through the dividends and also offer the capital appreciation over a long term. What is a defensive stock? These are the stocks of the companies that are less sensitive to the changes in the company and the economy and tend to perform well during the economic downturns. So these companies are often in the industries that provide essential goods and services such as utilities, healthcare, and the consumer staples. The examples of the defense stocks include the companies like Procter & Gamble, Johnson & Johnson, and Walmart. Investors often view defensive stocks as the safe investments because they tend to be less volatile than other type of stocks and provide steady income through the dividends. So in summary, we can say the blue chip stocks are the stocks of the large, well-established company with a long history of steady earnings and the stable dividends, while defensive stocks are the stocks of the companies that are less sensitive to changes in the economy and tend to perform well during the economic downturns. Both types of stocks can provide stability and the steady income to an investor's portfolio, but they serve different purposes and can have a different risk profiles. Both the stocks have historically been viewed as safe investments. They have the different characteristics and can serve different purposes in the investor's portfolio. So let us now do a difference between the block and the bulk deal. A block deal is a transaction that involves a large quantity of the shares being bought or sold between two parties outside of the open market. So these transactions are usually negotiated between the institutional investors or the big players who want to execute a large trade without affecting the market price of the stock, whereas the block deals are typically executed at the price that is negotiated between the buyer and the seller, and the details of the transactions are disclosed to the stock market. Whereas a block deal is a type of the stock trade where a large number of the shares, usually at least the 5 lakh shares or 0.5% of the total shares of the company, they are bought and sold between two parties outside the open market. So these are the proper features of the block deals. They have a large transaction cost, and it is pre-arranged. The block deals are pre-arranged transaction between the two parties which are executed in the open market. Then we have a confidentiality. The block deals are usually confidential, as the parties involved may not want to disclose their identity or the intentions to the market. Since the block deals involve a large number of the shares, they can have a significant impact on the stock prices. And if the large number of shares are sold in a block deal, the stock market may decrease, while a large purchase may cause the stock prices to increase. We have the price negotiations in this. We have a limited impact on the market. So, the block deals are often negotiated between the buyers and the seller, which allows them to a degree on a price which is mutually acceptable, and the block deals have a limited impact on the overall market price as they are executed outside the open market and do not involve the multiple buyers and the seller. So, a bulk deal is a transaction that involves relatively large quantity of the shares being bought or sold by a single investor in a single trading day. So, we talk about the reporting requirements, we talk about the liquidity, and then we talk about a bull market. A bull market is characterized by a rising prices and the investor optimism. So, it typically occurs when the economy is strong, unemployment is low, and the corporate profits are high. So, investors are willing to buy stocks or other assets because they believe that they will continue to increase in the value over time. Then the last is your bear market. A bear market is characterized by the falling prices and the investor pessimism. So, it typically occurs when the economy is weak, unemployment is very high, and the corporate profits are low. So, the investors are hesitant to buy the stocks on the other assets because they believe that the prices will continue to fall. So, there is a systematic risk, there is an unsystematic risk. So, a dwelling of understanding of these types of risks are also very important when an investor talks about investing in the stock market. Thank you very much.